Welcome back to the deep dive.
Oh, to be here.
We're taking your source material, digging through it, and pulling out the key stuff.
Yep.
And today, well, it's a topic that affects a lot of us, one way or another.
Yeah.
Tips.
Oh, yeah. Earning them, giving them, it's everywhere.
Exactly. So our mission for this deep dive is to really unpack some new tax provisions about tips. Stuff straight from the material you sent in.
Okay.
We're going to focus on two main things. First, there's this brand new tax deduction for individuals receiving tips.
Right.
And second, a pretty big expansion of a tax credit for employers, also related to tips.
And, getting a handle on these specifics, it's actually really valuable. It's almost like knowing the inside track in the service economy.
How so?
Well, if you're getting tips, you need to know about, potential new tax breaks, right? How that affects your take-home pay.
Makes sense.
And for businesses, the employers, well, expanded tax credits, that could be a significant boost to their bottom line. It's not just fiddling around the edges. It kind of shows recognition of how things are changing, in the service world.
Okay, so let's unpack that first one then. The new deduction for individuals.
Right.
The notes call it an above-the-line deduction for qualified tips. Now, for listeners, above the line, that's generally good news, right?
Oh, absolutely. Yeah. It reduces your taxable income before you get to other stuff like standard or itemized deductions. So it can really lower your overall tax bill.
Okay. So who's it for? And what makes a tip qualified? Seems important.
Yeah, the qualified part is really clearly defined here, which is interesting.
Oh.
For a tip to count, it absolutely has to be paid voluntarily, by the customer.
Involuntary.
It can't be something you negotiate.
Right.
And, this is key, the amount has to be decided by the person paying it.
So not like a mandatory service charge then.
Exactly. That wouldn't count. This definition, it really clears up any confusion between a real voluntary tip and some kind of fixed fee.
I see. It draws a clear line.
It does. It says, look, for this tax break, this is what we mean by a tip.
Okay, so who gets it? It says individuals and jobs where tips are traditional and customary.
Yeah.
But here's something that, well, it jumped out at me. It's not just for regular employees, like W-2 employees.
And that's right.
The material says it also covers independent contractors, people getting 1099-Ks or 1099 NECs.
Or even if they just reported themselves on a Form 4317.
Yeah. So that seems pretty broad in terms of who could benefit.
It is.
But, and this is maybe the kicker, it's only for tax years 2025 through 2028.
That's right.
Why? Why this specific time frame? It's not permanent.
That's a really good question. And, well, it's kind of typical sometimes. But first, about the scope, while it's broad on employment status, there are limits.
Like what?
You need a work-eligible Social Security number to claim it. That's one thing.
Okay.
And it specifically excludes tips received in certain, let's say, high-earning professional fields. Doctors, lawyers, accountants, that sort of thing.
Right, not those professions.
And it's also not for people right at the top. Income-wise.
Yeah.
Highly compensated employees earning over a certain amount, they're excluded too.
So it's really targeted.
Very much so. It seems aimed at, lower to middle income workers who rely on tips.
Okay, but back to the timing, 2025 to 2028. Any idea why it's temporary?
Well, Congress often does this. It could be like a test run. A pilot program. They might want to see how it works, what the impact is, or maybe it's just, a temporary measure while they figure out bigger tax reforms down the line.
So it leaves things a bit uncertain after 2028.
It definitely does. Leaves us all wondering what happens in 2029.
Yeah, okay, so that's the individual side. Big changes there.
Potentially, yes.
But tips also really matter for businesses, the employers.
Absolutely.
And our sources point to an equally big shift for them concerning the FICA tax credit.
Right. The FICA credit.
And just to remind everyone, FICA, that's the Federal Insurance Contributions Act. It's the payroll taxes for Social Security and Medicare. Now, before this change, that FICA tip credit, it was pretty narrow, wasn't it? Mostly for, like, restaurants.
Yeah, primarily focused on cash tips for serving food or beverages, delivery too, but mainly that sector.
But now, it's expanding.
It is, yeah. And this is quite a significant move if you look at the service industry landscape.
Okay, tell us more. What's changing?
The big change is that this FICA tax credit, which covers a part of the employer's share of Social Security taxes on cash tips, is now being extended to include beauty service establishments.
Beauty services. Wow, okay. So, like,
salons, barbershops, nail places, spas.
that seems like a major expansion. It kind of levels the playing field with restaurants, doesn't it?
In a way, yes. It acknowledges that tipping is customary in those fields, too.
So if you own one of those businesses, this could be a pretty big deal.
It really could.
The notes are specific. It says the credit applies to tips for providing beauty services as long as tipping is, well, customary there.
Right, the customary part is important.
And to list them out. Barbering, hair care, nail care, aesthetics.
Body and spa treatments, too.
So it really goes way beyond just food and drink now. It seems like a nod to how important that beauty sector is economically.
Exactly. It's expanding on the current law, which was, like you said, quite limited before.
Yeah.
This just recognizes, okay, tipping is standard practice here too, so let's give these employers a similar tax benefit to what the food and beverage industry gets.
Right. It's about fairness across the tip service economy.
Seems to be the idea. Supporting businesses where tips are just, part of how people get paid.
Okay. So I think that covers the main new rules pretty well, both for individuals and businesses.
Yeah, those are the two big headlines from the source material.
So let's just circle back quickly. Key takeaways.
Good idea.
For individuals, there's this new above-the-line deduction for qualified tips.
Right. And qualified means voluntary, amount set by the customer, not negotiated.
And it's for folks in jobs where tipping is normal W-2s and independent contractors.
Yep. But remember, the exclusions need a work-eligible SSN, doesn't apply to certain high-earning professions or highly compensated employees.
And crucially, it's only for tax years 2025 through 2028. For now, anyway.
Exactly. That temporary nature is key.
Okay. And then for employers.
The big news is the expansion of the FICA tip tax credit.
Beyond just restaurants and bars.
Right. Now includes beauty service places, salons, barbers, nail salons, spas, as long as tipping is customary.
So that's a real tangible tax benefit for businesses in those sectors now.
Definitely. It offers a real incentive or support that wasn't there before.
Okay. Which brings us to, well, our final thought for you, the listener, to kind of chew on. How might these specific changes, especially, the individual deduction being temporary, just 2025 to 2028.
And the FICA credit now covering whole new industries.
Yeah. How might all that influence what happens next? Could it change, compensation structures? Or even just the whole culture around tipping in the service industry?
Could this be maybe a first step towards something different?
Yeah.
More formal tipping models, or maybe something else entirely?
Something to mull over.
Yeah.
Until our next deep dive,